Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Whit Huguley, the portfolio manager at River Oaks Capital. Whit is a microcap specialist who has been running this portfolio full-time since early 2020. Whit puts together one of the most comprehensive quarterly letters I've ever seen, in many cases discussing all of the companies in his portfolio. As I learned more about his process and philosophy, I became curious about why he first became interested in microcaps, the checklist he uses to evaluate stocks, his rationale for investing in small banks and financials, why he places so much value on traveling to meet with companies, and how he approaches the topic of when his companies will eventually get valued properly. And without any further ado, here's my conversation with River Oaks Capital's PM, Whit Huguley. Whit, you seem to have a passion for the microcap space. I'm curious about where that interest stems from.
Yeah, thanks for the question. I think I'll just start off from the beginning. From New Orleans, grew up here, and I worked for right after college, worked for two startup companies, and really kind of grew an interest into how to make a business grow. Was really fascinated by that, but realized I didn't really have the business acumen background. I got a political science major in college, and just wasn't just felt like I was lacking in that area. So went back and got my MBA. And honestly, I went back to get my MBA thinking that I would, once I graduated, I would start my own company, something in venture capital, similar to what I had been working in before. And then the first semester, I took this investment analysis course, and I just immediately fell in love with investing. I read, thank God I had a professor that made me read The Intelligent Investor. And I mean, I know it's like stereotypical, but I just had that experience that like Warren Buffett talks about and so many other investors talk
That's
about.
my story too, by the way. Just
Yeah,
to interject. Exact,
yeah,
it wasn't a professor, it was a friend, but the exact same story about Intelligent Investor.
yeah. It's like I think Warren Buffett calls it inoculation, where it was like when I was little reading a Harry Potter book. I just like could not put the book down. I didn't even realize what was happening at the time, but I just like totally caught the bug. I guess this was about 10 years ago now. Um, and I just, after that, I read every investment book I could get my hands on. Just became obsessed with it. Got my CFA while I was, or started getting my CFA while I was at getting my MBA. Then when I graduated, went out to work for a private equity firm in California called AGR. Um, right outside of Sacramento in Davis, California. And that's where, I mean, I got incredible hands-on experience. It was a pretty small deal team with a lot of capital. So I was allowed, and I was doing everything, doing a lot of the due diligence, the investment process, meeting management teams. And I mean, like the passion I had before just like continued to grow when I was in private equity. And I think it was there that I really learned. I think I have the quote written down that Warren Buffett says, but he says, shares are not mere pieces of paper. They represent part ownership of a business. So when contemplating an investment, think like a prospective owner. And when I was in private equity, I really understood what he meant by that. That, you're not just trading pieces of paper. But while I was there, along the way, I just fell in love with public equity investing. On the weekends, anytime I had time after work, I was investing family and friends' money in the public markets. And there was just something about like the hunt of looking for cheap, at the time, very cheap companies that I just loved. And so in 2020, I started my own fund, moved back here to New Orleans, and obviously it was as January 1st, 2020 was an interesting time to start your own investment fund. Um, at the time, I was investing probably mostly in larger small cap companies. And obviously I wasn't able to visit companies because of COVID. And to be honest with you, I really didn't even call companies that often. I would now and then. And I had, I think, about one or two microcap companies at the time. And then once COVID lifted, or the restrictions lifted, and I was able to start traveling to meet management teams, and I met a few of these microcap companies I owned, a light bulb just went off, that this is how I can provide value to my investors by putting in the time requirement needed, to really understand. I mean, I always knew that, I could see from a analytical standpoint that microcaps were really, really cheap. Like they were the only area that I saw that was offering the type of discounts that Ben Graham talked about, an intelligent investor. But I just assumed they were all cheap because there was a catch. They were not shareholder friendly. They were misallocating capital. I mean, sometimes even worse than that, like actual fraud. Um, but I realized that, by visiting these microcap companies, and I guess some of the companies I own would be considered like the smaller end of small cap, you can discover whether or not there's a catch. And oftentimes you show up to these companies and you realize, okay, now I understand why it's trading at 5 times earnings. There is a lot wrong here. Um, and I'm glad I visited. And then sometimes you sit down, you go to Fort Worth, Texas, and sit down with Dayton Judd at FitLife, which I own shares in, or my fund, River Oaks Capital, owns shares in. And you discover just a wonderful business that no one has found. Dayton could be a Fortune 500 CEO if he wanted to, in my opinion, but he just likes to stay underneath the radar. And it really started to click, and I really got motivated probably a year and a half into, um, running River Oaks Capital, where I felt like I was truly providing value to my investors by getting to know these management teams. And, they're few and far between, but there are wonderful companies out there. In my opinion, it takes the time requirement, just because there's not written reports out there or much you can learn. It takes the time requirement of traveling, getting to know these management teams. And I mean, as I say in kind of the River Oaks Capital investment slogan is, we act like a owner long term, as if we are an owner with long-term interest in the company. So just really doing the due diligence as if we're buying ownership in a private business.
As you're talking, I started to think about the value of meeting management teams, but there's also a time cost and obviously a financial cost. But so I'm curious about what's the hurdle rate for actually going to visit someone? I mean, if they're in New Orleans, it's different. But let's say you have to travel. What
Yeah.
what do you need to see in a company? How much work do you have to do? What is the hurdle rate for making that trek?
Yeah. I mean, what I do first off is have a Zoom call, or a phone call of some type. I mean, the best. I mean, ideally, they're at a conference I'm going to anyways. But I mean, once it checks off, I have an investment checklist of um, six things that I go through. And once it checks off most of those boxes and the valuation's right, I just hop on a plane and go visit them. I just feel that even if it's not a company that I end up investing in, it's an incredible learning experience to get to talk to these companies, and it makes me a better investor. Um, I mean, it can be a time requirement, but to be honest with you, that was something I had a lot of concern about when I was starting the fund. Like, how am I going to visit these companies? And it's kind of just worked out. It always seems that like whenever I'm interested in a company, I happen to be going somewhere nearby, or they're at a conference, or I'll just get on a plane and go visit them. But it's been such an eye-opening experience doing that, visiting these management teams in person. It's like, um, yeah, it's really, I think it's the most important thing I do. So my hurdle rate is pretty low. I mean, as far as once I talk to them and it looks like a potentially good idea, I'm going to get on a plane within that a month or two and go visit them.
And you mentioned that in some cases you can find a wonderful business that's under the radar, but in other cases you can tell something that there's immediately that there's something wrong. I'm curious about that latter situation. Like, what are you looking for? Is it the physical offices? Is it the way the management treats people? Is it just the way they talk to you when they're in person? Like, without obviously giving examples of with company names, but I'm curious, like
Yeah.
generally when you've had negative experiences and said, I'm not going to touch this thing. What kind of things happen?
I mean, I think the first thing I really look for is skin in the game, someone that owns a large percentage of the company. That's not foolproof, but I mean, there's so few eyeballs on these companies that you really need someone with skin in the game in microcap companies. There's no analyst most of the time covering the company. There's no one actively looking to make sure that they're not expensing a corporate jet or doing things that they shouldn't be doing. So that's really the first thing I look for. It's not foolproof by any means, but at least if they are doing something um, non-shareholder friendly, they'd be shooting themselves in the foot more than anyone else. Um, but what I've experienced as far as companies that I visited that have not checked off all the boxes is A, there's not someone with a lot of skin in the game. They are running the company to pay themselves a salary and the board's a salary. They're not really concerned about what happens with the rest of the free cash flow after that. Um, Something I've noticed that someone with a lot of skin in the game, and I'll use a company I own called Legacy Housing. I went and visited Kurt and Kenny, the two CEOs there, and right outside of Dallas. And when I sat down and met with them, the first things that they started bringing up is what's wrong with the business, what they're doing wrong, where they can improve. Um, this is the areas that we need vast improvement on, but here's the areas we're great in as well. It wasn't a sales pitch. Um, it wasn't a no, we're perfect. It was you could tell you were talking to an owner of the business, and that's what the similar experience I've had with every other wonderful company I've invested in is you could tell you're talking to an owner in the business versus, for lack of a better word, just a promotional CEO that's trying to get the stock price up or trying to grow the size of the company so they can increase their salary. I would say that those are the things that come top to mind. I'm sure there's other specific stories I'm missing out on, but yeah.
And you mentioned the checklist that you use, and so I wanted to jump right in there. So
Yeah.
I was looking through your website and I saw that you have an owner's manual and that checklist that discusses the things you look for in stocks. I thought it'd be fun to go through each of them and understand what you mean. Starting off with a company that has a wonderful product. What does that mean to you?
Yeah, sure. So I'll read exactly what I say. It's a wonderful product. It says sells a wonderful product that will generate substantial cash flow for years to come. And I think that years to come is kind of the key in the in that sentence. So I think companies can make above average returns for their shareholders in two different ways. They can generate a significant spread between the return on capital and their cost of capital, and they can maintain that spread for a long period of time. So I guess it's not two different ways. They have to be doing both. But a lot of micro cap companies I notice are good at the first one, going after something that will generate excess return. or a high return on capital versus their cost of capital, but the ability to maintain that spread for an extended period of time, I think is what a lot of people, a lot of investors miss out on. So you'll hear, not that I don't even know if a company is specifically doing this, but trying to invent the next electric RV. If they are successful, maybe for a year or two, they will generate abnormally high returns for their shareholders, but then some major competitor is immediately going to dive in, and that duration, that spread in between return on capital and return and cost of capital is going to narrow immediately once a large competitor jumps into the market. So what I'm looking for is wonderful products that it's a company that dominates a niche, obscure market that's just too small for major competitors to attack. And they might not be getting a enormous spread on the return of capital versus their cost of capital, but they're just able to do that for years and decades and continue to just slowly and conservatively, and sometimes even quickly grow the business. I think I don't own the company, but the classic case example in microcaps would be XPEL, where they just had this dominant niche, they dominated a niche market, and they were just able to continue to grow and grow. And I mean, what they've done, I mean, alongside that, their CEO Ryan Pape is like one of the most impressive CEOs I've met in microcap land. So there's certainly that aspect to it as well. But I mean, so that's really what I'm looking for, and I go on to explain in further detail in the owner's manual. But so a business that's dominating a niche, I just call it a hidden moat, because they're dominating this niche market that no one is really paying attention to. And if a competitor did want to enter, it would probably make more sense. If a large competitor wanted to enter, it probably would just make more sense for them to just buy the entire company rather than try to compete head on with this company. And actually, in the owner's manual, I have a Warren Buffett quote that I can read real quick that I think sums it up pretty nicely. It says, "The key to investing is not assessing how much an industry will grow, but rather the competitive advantage of any given company, and above all, the durability of that advantage." So I really think that microcap companies would have a hard time getting a durable advantage in a well-known, well-followed market. So I'm really looking for a company that dominates a niche, just hidden market.
And the next thing on the checklist has to do with culture. So on top of the wonderful product, I'm curious what you look for when it comes to company culture.
Yeah, I think that's probably one of the biggest reasons I visit companies is that's not something you can pick up on by reading a 10K. And that's why I like visiting companies, but also going to the shareholders meeting. I think even at the shareholders meeting, you can even pick up on the culture even more when there's other employees and the boards around. And, there's not really like a tangible checklist I go through. I mean, there are certain things I look for: integrity, honesty. They're passionate about the business, and everyone around them lives and breathes what they're doing. But it's something I just feel like I could feel when I'm around it. A company I own that I think is a good example is Boston Omaha. Whenever I go to the shareholders meeting and whenever I meet with Adam and Alex, the co-CEOs, I just feel something different. I feel a lot of trust. I feel a lot of, I think it would be it's a similar feeling to how I feel when I visit or go to the Markel meeting or the Berkshire Hathaway meeting. You just feel like the culture is in place there. So I think for a specific example in microcap area as well, a company I own, Citizens Bank, in their 10K, they talk about we're a very conservatively run bank. It's a community bank based in Atlanta. And they preach it in their 10K, but it wasn't until I went to their shareholders meeting. It was myself and two other outside shareholders, but there was a lot of employees and board members that I could tell they practiced what they preach. They are conservatively run. and they're not going to do anything to risk jeopardizing this 100-plus-year-old bank. And you could just feel it when you're there. And I don't think there's any other way to do that due diligence other than visiting, in my personal experience.
And you've already touched on skin in the game and integrity, but the next category is kind of the ownership side. And it sounds to me like you just want to make sure that you're aligned. Is that really what you're looking for when you're thinking about, how much stock someone owns in the management team?
Yeah, I think so. I think I kind of already addressed it slightly earlier, but I'm looking for someone with skin in the game just because there's so few eyeballs on these companies. And I've visited companies that are expensing things they should not be expensing through the company, or paying too high of salary. But to go back to when I met with Dayton Judd of FitLife, which I own shares in, or we own shares in, um, he made it very clear that if I do anything unshareholder friendly, I'm hurting myself way worse than I'm hurting anyone else. He owns over 40% of the company.
Yeah.
Um, so it's not foolproof, and that's why I still want to go. I don't think just by having skin in the game, you're aligned. Just by someone having skin in the game, you're necessarily aligned with them. And that's why I want to go visit companies in person to also assess their character. But I would have a lot of trouble buying a company um, without someone with skin in the game. It doesn't have to be the CEO. It could be the chairman of the board. It could be the largest outside shareholder who is always around the CEO and chairman of the board. Um, but it feels like a almost almost, yeah. I can't see myself investing without checking that box.
And you mentioned risk aversion in the context of Citizens Bank. It's another thing that you look for. Is that, I guess with a bank, it's probably about the balance sheet specifically. But are there other elements as well? I mean, how does that manifest itself in like an industrial company, for example?
Yeah, I mean, first and foremost, it's debt that I look for. Not too much debt, especially in microcaps, where a lot of times the debt will be variable debt, or or both. There'll be strict covenants as well. I think it's dangerous to have debt. It's super dangerous to have debt in microcap companies. They're also mainly not very well diversified. So if their industry suffers, debt could be really constricting. I think the second piece that I look for is operating leverage. Um, and I think, the reason in microcap companies specifically, it's really important is because they're already going to have an excess percent of operating leverage due to the cost of being a public company. Um, so, there's just the necessary costs that you have to pay of being a public company, which have gone up since, 08, 09, specifically. And so if you have high operating leverage on top within the business, on top of the public costs that it takes to be a public company, or yeah, sorry, to be a public company, that could also be really risky as well. So, I mean, what I'm really looking for is a company that can weather any substantial storm, and they're not trying to grow the company um, with a trade-off of sacrificing the company if things get bad, and whether that's through financial leverage or operating leverage. I'm trying to look at both sides of that. Um, also trying to make sure that if there is a huge downturn, they're not going to dilute shareholders. That's another huge risk in microcap companies, especially because it's not easy to raise equity.
Mhm.
So you're not going to get a favorable equity raise, especially if it's in a time of need. The third part, and I kind of go into it in the next bullet point of the checklist, is just a long-term plan. When I'm thinking about risk, I want to see a company with a long-term plan, because I mean, if you look at a lot of microcap companies a couple of years ago, they were getting into Bitcoin and blockchain and just like total like companies that have nothing to do with either of those industries, and that's a equally as big of a risk. Is all of a sudden they just take a left turn in their plan and start chasing something that was not something you had invested in at all.
And so you talked about the long-term plan, and the last thing on that list is looking for businesses that trade at a discount to intrinsic value. So this is a good time, I think, to talk about your desired margin of safety and also describe how you typically approach valuation.
Yeah. Yeah. As far as, going back to the long-term plan, I think like when I really realized it was important was when I visited a company on America's Car Mart, and they're located in Rogers, Arkansas. And I was meeting with then Jeff Williams, who just retired, but he said, we don't get much value out of being a public company because we're thinking 5 to 10 years out, and many of our investors are thinking next quarter. And that just was music to my ears, but also it just really was like, okay, this is the type of company I want to get behind because, um, in a downturn is where America's Car Mart gains their market share. So that was, I mean, that's why it's part of the bullet point. But sorry to jump back, but going to intrinsic value, um, I would say I spend intrinsic value and valuation. I would say I spend 90% of my time thinking about downside protection. That's just how I'm wired. I've always been that way. And I'm poking a hole or poking as many holes in the company to see that in a downside case scenario, if something totally from left field happens, can we still get the market cap back, the current market cap back? And I think in microcap markets is the one area where you really can find those opportunities. And if you put in the time requirement that I've talked about of traveling, getting to know management teams. But going from a specific valuation standpoint, when I'm investing in a wonderful business, which checks off the 6 bullet points that are on my website in the owner's manual, I'm looking for a 70% or less of intrinsic value, or what I determine as intrinsic value. And then there's also a second group of companies I invest in, which I call excessive discounts, which would be similar to what Warren Buffett called cigar butts, which I'm looking at companies that are 50% less, 50% or less of intrinsic value. And, wonderful companies I would much, much rather invest in. There's no doubt about it. But there's sometimes where I just come across these companies in microcap markets where it would just be a disservice to my investors to not invest in them. It's like no matter what happens, we could get the current market cap back, and it really is a true 50-cent dollar. Um, so that's how I think about scaling what percent of intrinsic value I want when I'm looking for fair valuation at an entry point level. From an actual valuation standpoint, I'm thinking about free cash flow to equity. That's really all I'm thinking about for the most part. And I want to see a company that has double-digit free cash flow to equity yields. Obviously, I adjust that slightly upwards or downwards depending on the growth potential. But that's really what I'm looking for. And, I think if I thought about it in terms of if I had a minority ownership in a private chain of restaurants here in New Orleans, let's say, and I paid 100, or that ownership was valued at $100 million, or the entire restaurant chain was valued at $100 million, I would want $10 million or more free cash flow. So I don't think that's an unreasonable demand to get a double-digit free cash flow margin from microcap companies as well, because they would be a similar size as a $100 million restaurant chain. And it really is the one area of the market where I think it really is possible to do this. And I think, whenever I'm thinking about free cash flow, there's a Tom Gaynor quote that I always read that he basically says that a publicly traded company is 90% dominated by the free cash flows they produce over time and 10% dominated or 10% by what the market will pay for them. So it really is thinking about how much free cash flow can I get out of this company over the long term is what I'm thinking, not how much will someone pay for this business next year.
I think that was a great summary of what you look for in companies. I would love to also jump into portfolio construction. So I know that you run pretty concentrated, 8 to 15 stocks. I'm curious about how you settled on that number because I think a lot of people see concentration in microcap as excessively risky given illiquidity issues and then obviously perception of about the durability of these businesses. So talk to me about how you settled on that 8 to 15 number.
Yeah, sure. Yeah, that's a great question. And it took me a little while to get there. But I think, I mean, first and foremost, passive investing has become so popular throughout all investors. And I do think that microcap markets, activist investing or active investing really makes a lot of sense. I do think if you put in the time requirement that I've mentioned of visiting management teams, reading 10Ks, doing all the due diligence that a lot of people don't want to do, you can you can beat the microcap um, index. It's not going to necessarily be easy, but I think it's achievable. I think one way it's definitely achievable is by just getting rid of some of the bad companies. I think in mid cap and large cap, you'll have a lot of companies that are probably overvalued. But I don't think you'll have many companies that are just truly not run for shareholders or like even worse, frauds or um, just something not right is going on. So I think there's that. But when I think about concentration, even in inefficient microcap markets, the opportunities are few and far between. Um, if there were 30 Dayton Judds running FitLife, I would gladly invest in 30 companies. But that's just not what I found. And it's there really are, even in inefficient markets, few opportunities that I find investable. And I think, it's I forget exactly how the Charlie Munger quote goes, but he's basically just like saying the wise ones bet heavy when they have that opportunity. Other times they just don't. They just sit on the sidelines and wait. And it's whenever I find the few and far between wonderful companies or just extremely excessive discounts, I make sure to make it a large percent of my portfolio. And that's just what's made sense for me. But I've seen many people do it other ways as well.
And when I look at your portfolio, you have companies that range from, I think, $12 million on the low end to over 600 million. How do you think about position sizing when you have what I would assume is a pretty big range in terms of how liquid these companies are?
Yeah, yeah, that's a great question. I ask that question to a lot of people when I'm talking to them as well as how do you think about position sizing? For me, the most heavily weighted companies in the River Oaks Capital portfolio are those that have the most downside protection. That's how I really think about weighting. I think, a company I own that I already mentioned, Citizens Bank, which is a community bank based in Atlanta. The valuation that we bought the company at, I think the entire bank could have collapsed and we still could have got the market cap back. So when I find scenarios like that, I heavily weight them. And that's how I think about position sizing. Or that's the first thing that check mark when I'm thinking about how much to make it in fund. But I mean, and the reason I'm so neurotic about downside protection is like what you mentioned, it's really hard to get out of a microcap company if you're wrong. You really do have to have an owner long-term mindset when you're buying these companies, because oftentimes you'll end up owning a few percent of this company, and you really do have to view it as if it is a privately held business ownership. And the Warren Buffett saying, be okay that if the stock market closed for 5 to 10 years. And that's how I'm thinking about position sizing is these companies are so attractively priced and but at the same time generating free cash flow back to us while we're waiting. Those are the companies I make the largest percent of my portfolio. But it's a question I'm constantly asking other investors and trying to learn on as well.
And it would occur to me that your experience in private equity probably had a big impact on how you think about investing in public markets. Do you feel like that experience has led you down the path to thinking more like a long-term owner and acting more like an long-term owner, even with the risk of getting involved in illiquid things?
Yeah, I think I didn't really like pick up on that's where it came from until maybe a year or two into the fund. I was like, I do think I'm investing a little differently than a lot of people, where I am thinking I'm approaching the investment as if I'm going to buy the entire company. And I think, when you get on the private equity side of things, you see the nuances that go on day to day that you don't see when you look at the 10K. An employee gets sick. There's multiple things that go on through day-to-day businesses that don't show up in an Excel spreadsheet, don't show up in an SEC filing. And yeah, I think I didn't realize it, but I think that's where my desire to visit all these companies in person came from, as I saw it from a private equity standpoint. I got to work with an amazing team at AGR. And yeah, it's changed my mindset in thinking that we're okay being a long-term owner here. We don't need to predict what next quarter's earnings are going to be. And obviously you have to think about that even more in microcaps. Because as I mentioned, and as you mentioned, it's very hard to get out of if you're wrong. So I think naturally I was attracted to microcaps as well because it's a space that um, where that type of mindset works very well. Because whether you like it or not, that's what ends up happening is you become pretty much a private business owner. And I really like that part of it. I really like getting to develop relationships with the management team, with the other investors in the company, and really viewing it as if I'm have ownership in a private business. It's really gone a long way. And I think it is. Maybe it was before I went to private equity, but it certainly got reinforced when I was there. Um, that there are many nuances to a business outside of what you read in the filings and um, in an Excel spreadsheet.
And given that no one has a 100% hit rate on ideas, obviously everyone is wrong at times. So I'm curious about how you think about sell discipline, especially if you think you've identified one of the wonderful businesses and it's not, maybe working out. Obviously it's if you have a 5-year time horizon, the things that happen over the first 18 months can be tolerable, even if they're not always positive. But I'm curious about what sends you to, or what makes you or pushes you to exit something where you did initially hope to own it for 5, 7, 10 years, something like that.
Yeah. Um, yeah, it's like one of the hardest questions in investing. I don't think I've ever heard an answer that's applicable to all circumstances is when to sell. It seems very circumstantial. But when I'm thinking about it, I'm going back to the private business mindset. If I had a minority ownership in restaurant chains here in New Orleans, why would I sell? And, I think the list is management ends up being dishonest or worse. Someone's offered you too good of a price to ignore. So I can think back to 2021 when I was following Viacom, or I guess, yeah, it was still Viacom. It's Paramount now, which was a mid-cap company. I was just following it because I found it interesting. And it was trading at $20 a share, and I thought it was worth $35 a share. Um, and I don't own any, but the stock price went to $120 a share because there was just this, I think it was a short squeeze. And I mean, at that point, you sell. Like, the third reason I would sell if I owned a restaurant chain here in New Orleans is if they took a left turn and said, we're going to close down all the restaurants and start building water parks. So like, all right, that's not what I was signed up for at all. And the fourth would be just if my investment thesis changed or was proven wrong. You know, if it was a steak restaurant chain and it turns out that the demand for steak isn't here in New Orleans. And um, but I think that's the hardest question to answer. And I think it's a little more simple for excessive discount cigar butt companies when they're approaching close to fair valuation. And it doesn't even have to be full valuation, full fair valuation. I'd sell. For wonderful businesses, the answer is cliche, but the goal is to never sell it unless you get a Viacom Paramount situation where just it's offering you a price is just too good to be true. Um, but I think that's why you need an owner long-term mindset when going into these companies because you just can't buy them for 6 months and say I'm going to own it for 6 months, see how it goes, and if I don't like what's happening, I'll sell. And microcap companies, you just can't do that. It's not going to work. You have to approach it as if you're going to own it forever, especially with these wonderful businesses. So, I mean, the one lesson I've learned as far as when to sell is that if a wonderful business turns out to not be a wonderful business, and then all of a sudden becomes an excess discount, don't change the thesis and say, all right, well, now this is an excess discount and I'll keep investing in the company. It's just sell the business, take the tax loss, and move on. That's the one lesson I've certainly learned on selling is don't change your mind halfway through that, oh, this business I thought it was wonderful, but now everything's gone wrong. It's so cheap. Now it's an excessive discount. That logic has never worked. At that point, just sell and move on because as you said, you're not going to bat 100. I think Peter Lynch said 6 out of 10 is good. So, yeah, that's how I think about it.
And I think one of the things that people worry most about in the microcap space is that um, they ask the question, why would these things ever get fairly valued? If there's so few people looking at them, like what is the price discovery mechanism? And so in a recent letter, you discussed the lack of price discovery that currently exists in microcap, some of which has been exacerbated by the rise of passive investing. When people ask you about why your stocks would ever get revalued appropriately, how do you answer that question?
Yeah, I mean, going back first to the lack of price discovery, maybe I'm wrong here, but it seems like it's gotten even worse since I've been investing or since I started River Oaks Capital in 2020. It seems like the lack of price discovery and the inefficiencies have got even worse. And I think you could see that by the discrepancy between valuations and between microcaps and the S&P 500. I mean, obviously there is a justification for the valuation cap. S&P 500 companies are going to be on average much better companies, but the gap is enormous right now. But when I'm investing in a company, my base case thought or scenario is that the price will never change, that the market cap will remain the same throughout the entire investment process. we will only get our return through the free cash flow of the business. So whether that's through dividends, share buybacks, or reinvesting capital back into the business at above market returns, that part I don't really care how the free cash flow comes back to us. But my assumption is not that I'm going to buy this business and then one day it's going to get bought for more. It's how can we make a above average return for my investors if the market cap never changes. So, a company I own called Medical Facilities, um, over the last year and a half, they've bought 30% of their shares. They bought back 30% of their shares. They paid a modest dividend and they paid down a ton of debt and they sold a bunch of non-core assets to buy back shares. And that's the type of investment I'm looking at where the share price doesn't have to move and we're still getting compensated while we wait. But I mean, to answer your question, how do I communicate that they'll be fairly appropriately valued? I think first and foremost, I communicate how much free cash flow we're getting out of the business so that we don't need to make a return by the price going up, or the price doesn't have to go up in order for us to make an acceptable return. But that's also why I try to write fairly long letters each year to the shareholders. It's to communicate that although the price may not reflect it, here's how the business has improved over the last 6 months. Here's how intrinsic value has increased, and here's how free cash flow has increased. And I think I'm not sure if you've ever read Nick Sleep's letters, but I think he does a really good job of communicating that as well. Um, here's how much we think intrinsic value has increased, and it's totally irrespective of to what the share price is at the time. And I think in microcap markets, that can be 100% true. You could have someone that, let's say inherited a bunch of stocks from someone and just randomly woke up one day and decided to sell. And it has nothing to do with the company. And the price could go down 20%. And what's happened in the last 6 months of the company could be nothing but growing intrinsic value. So I think sometimes it sounds like it's not true, but it is a situation I find myself coming across all the time, and I try to communicate that in the shareholder letters, and I hope it comes across well.
One thing that I wanted to make sure we discussed before ending this conversation was your interest in banks and financial institutions. You already mentioned Citizens. Outside of that company and its unique attributes specifically, I'm curious about what attracts you to microcap financials.
Yeah, there's not a specific macro thesis there. I'll pull up the financials on Citizens so I can just walk you through it. But yeah, there's actually not, each one is a unique situation. I didn't see something in financials that I found attractive. It just so happened, someone actually pointed out to me, it was like, you're heavily weighted in financials. And I think the microcap index is about 20% financials. And I think my fund's about 32%. But it has nothing to do with a macroeconomic thought. It's really specific to each company. But the reason for the three region or community banks is the ESA program that was put in place in 2020. I'm not sure if you've read much about this. My friend on Twitter, Dirt Cheap Stocks, has a great write-up outlining all this. But basically what happened was the US government deemed that minority and low-income communities were disproportionately affected by COVID. So in order to stimulate those economies, they gave very preferential preferred equity to each community bank in those areas. And most of those community banks are privately owned, but I think there's about 12 that are publicly traded. And Citizens, Bank First, and M&F are the three that I own. But when I came across this situation, I couldn't believe what I was reading. I was like, this has to be too good to be true. Citizens Bank was trading at, I believe, a 30 to $35 million market cap at the time when we started investing. The book value of the bank was $50 million, but they had just received $122 million in cash from the government. Um, well, from the government and a few large banks as well. And the most they can ever, it is the most they can ever pay on the $122 million of cash is 2%, and it's non-cumulative and lasts forever. So when I first read this, I was like, this can't be true. It has to be similar to TARP, where the government gave very friendly loans, but then year 5, they jack up the interest rates to 9, 10 plus percent to make you pay it back immediately. Well, I visited a ton of these banks, talked to a bunch of industry experts, spent a lot of time with the CEO and CFO of Citizens, Cynthia Day and Sam Cox, and then as well as the Bank First team, Moak and Luke. And I mean, I was poking as many holes as I could in this, and it was just there was no catch. And it was one of those huge opportunities that Charlie Munger talks about when you're waiting and then you find this massive opportunity, you bet big. So that's why I have a lot of financials right now. It has nothing to do with um, any of the macro things that have happened since then, the Silicon Valley or office real estate or anything like that. It's that um, if people have yet to, I mean, Citizens Bank has gone up some, but they've yet to realize that they have all of this cash. So they have a $50 million bank on this side and $122 million of cash on that side. So it's one of the most underpriced companies I've ever seen. So that's why there's so many financials. It has nothing to do with interest rates or anything like that.
Interesting. Yeah, no, it was hard to tell from the outside what the common thread is. So that was really helpful.
Yeah.
Um, so one thing that we need to talk about a little bit is the business of investment management because you're building an investment firm.
Yeah.
And so capacity is always something that's like first and foremost when it comes to in investors' minds when it comes to microcap. So I'm curious about how you've thought about the right AUM for you. Like where do you stop raising money? What's the right number that you would get to where you would say, this is the kind of market cap I want to play in, and above this AUM, I can't really play there. How have you thought about capacity?
Yeah. I mean, I think I've set a goal. I mean, first off, I'm not in the business to rapidly grow AUM. I don't think you would pick microcap markets if that was your goal. I think you would pick mid cap, large cap, or even like the higher end of small cap. But I think, the goal I had in mind was, somewhere around $100 million. I think you can still do. There's probably one or two companies in my portfolio where that might test the limits a little. But other than that, I don't think, I think that's a reasonable number. Um, I think that as far as, I mean, so the way I think about it is that, well, if as I'm growing, if that turns out not to be the case and I start limiting shareholders' returns, I'll immediately close the fund. As I said, I didn't pick microcaps to grow AUM. So if I feel like I'm constricting shareholders' returns by trying to grow AUM, I would immediately stop there. But I do think growing AUM helps River Oaks Capital, all of our investors, which I'm a large one as well, and in two different ways. I think I've structured it so that as the fund grows, the percent management fee goes down. So everyone's benefiting from the fund growing. Really, all I want the percent management fee to be is a proxy for the fixed cost of the fund. So once the fund grows, the fixed costs aren't going to grow at the same size of the fund. So the management fee will go down. I think on the other side, and part of the reason I've been really excited to continue to grow the fund is just the role I've started to play, want to continue to play as a suggestivist investor. And I think the larger portion of the company you own, the more they're going to listen to your suggestions. It's been, the first eye-opening experience I had was visiting management teams where I could provide value. Or the first eye-opening experience of thinking, oh, I can really provide value to my investors here. The second was how much help a lot of microcap companies could use on the capital allocation side, returning capital to shareholders, uplisting, investor relations, all those areas. And over the last year and a half, I've been really pushing to help in those areas. Again, treating it like it's a privately owned company, just finding ways where I can add value as an investor. And so I think as I grow AUM, I'll be able to push even more. And it's not like trying to take over management or anything like that, but saying, hey, you have $10 million of cash just sitting on the balance sheet. Have you thought about buying back shares, special dividend? And if so, if you're interested, I can introduce you to certain people who could help you in that area, or I could help. And so that's really an area where I feel like everyone at River Oaks would benefit by us growing.
And you talk about having a private equity mindset, long-term ownership in not pieces of paper, but companies. So that it occurs to me that you're really also looking for investors who are who are interested in being long-term partners. What does the profile of the right investor look like when it comes to River Oaks?
Yeah, I think that's a great question. But I mean, it started off as family and friends. That's how the fund started in 2020. And then when as I started sharing, or people started sharing my investor letters, and I was really pleased by the outreach I got from it. I was not anticipating that at all. People would share it on Twitter and other social media outlets. And I got a lot of outreach. And I think what I've realized the common theme is it's people who are trying to invest as if you're investing in a private company. It's not someone trying to invest thinking I'm gonna somehow figure out next quarter's earnings or anything like that. It's almost someone trying to get private equity exposure through a public market. Is the common theme I've noticed of people reaching out. I think the second reason people have been attracted to the fund is that I think, and I hope the word's slowly getting out how undervalued microcaps are. But I think the word's also getting out that it's not something you can easily index, and you do need a full-time investor, to put in that time requirement that I've talked about to go find these, needle in the haystack, a couple of wonderful businesses within microcap companies. So I'd say that's the two common themes. I think the most common theme though is long-term minded. It's just people wanting to invest in a business, not invest in a piece of paper that, you know, not trying to use this, as I say in the owner's manual, not trying to use the stock market as a casino. They're trying to use it as its intended purpose to buy ownership in the company.
And as we're winding down, I need to switch gears because I never want to leave a discussion with a manager without talking about mistakes. Is there an investment mistake that was so profound that has forever changed the way you make decisions?
Yeah, well, I made a ton of mistakes. There's no doubt about it. I think that is just the price of admission in investing. But I've made my fair share. I could go through a number of companies, but I think the one theme that has molded me or that I've improved on is I want to invest alongside management teams that are taking advantage of their underpriced stock. You know, I used to invest in companies that were just extremely cheap, but the classic value trap where time is your enemy. The longer it takes for someone to realize the fair value of the company, the worse your returns get. So a management team that is actively taking advantage of their mispriced shares by buying back shares, or it can be, paying dividends, but preferably buying back shares. But that's the real takeaway that I've gotten from mistakes that I've made. It's that just because a company is inefficiently priced now doesn't mean they can't get more inefficiently priced. And going back to Citizens Bank, I hate to keep talking about them, but over the last year, they've bought back $8 million worth of stock. And I still think the company is valued at 50 cents on the dollar. So if you do kind of the quick math, that's turning $8 million into $16 million. And there's not many other areas you can allocate capital like that. And it's something it took me a while to learn that um, that just because, as I said, just because a company is inefficiently priced, it can't get more inefficiently priced. But when you have a management team that's buying back shares and the price goes down and nothing material has changed in the company, you actually get excited because now they can buy back a larger percentage of shares. So that's one of the first questions I ask management is, are you willing to buy back shares? And it is a question I have learned from many mistakes I've made in the past.
And we'll close this great conversation with a question we ask all of our manager guests. Uh, we've already talked about the general mispricings in microcap, but I'm curious about what you think is the most underappreciated aspect of the investment opportunity in front of River Oaks today.
Yeah. Um, yeah, I appreciate that question. I think the most glaring thing is the undervaluation of microcap companies right now. I think that's the biggest underappreciated aspect. I think people are slowly starting to realize, but you can buy wonderful businesses for less than 8 times earnings with no debt. And I don't, there's not many other areas of the market that you can do that. And it's not because they're bad businesses, it's just because no one's paying attention to them. Um, and if you get someone who's willing to fly and to visit management teams, willing to dive through the financials, willing to talk to competitors, willing to go to conferences, doing a lot of stuff that most investors either don't want to do or don't have time to do, you can really find some wonderful businesses out there at extremely reasonable prices. Um, I think I already mentioned it a little bit, but I think the other part of the value is you can identify that microcaps are undervalued, but I don't really think you can exploit that undervaluation through indexing. Or at least it hasn't worked in the past. And I think that's just because there's a lot of speculative companies and a lot of speculative or worse companies out there. And River Oaks Capital was able to sort through those companies and make sure we're not buying ownership in those companies. So I think it's a very unique way to be able to exploit the undervaluation of microcap companies right now. I mean, sure, it's possible that microcap markets could get more inefficient, but as I mentioned, all these companies we're buying ownership in are either returning cash to us or investing at above market returns. So it's not really of the utmost importance that it does become efficiently priced. But that being said, I don't see how eventually larger pools of capital don't start seeing this opportunity. Um, it feels like only a matter of time, but who knows? But that's not part of the investment thesis. But it's just the main theme, the main underappreciated theme is the undervaluation right now. And yes, there are a lot of companies that there is a catch, and that's why they're trading at 5 times earnings. But there are some companies where there is no catch. And if you do the work, you can find some really wonderful companies out there.
I will say amen to all of that because, as you know, I'm, deep in the middle of trying to find that big pool of capital that's going to come and take advantage of those opportunities. Whit,
Yeah,
this has been awesome. I love the way you think about, investing in general. I like the way your private equity mindset is like so well suited for microcap. And you have the courage to be long term and concentrated in a space where other people have a lot of trouble with that. So we wish you a lot of luck, and we're going to be following your career closely over time.
awesome. Thanks so much, Ben. That was really fun.
Whit mentioned a number of securities on this podcast. I do not own any of them.